This lecture is over investment decision rules. I'm your professor, Dr. Stephen Haggard. While some of my accounting colleagues may disagree, I think that finance is more interesting than accounting because finance is all about making decisions about what to do instead of simply deciding how to record what has already happened. In other words, the aftermath of previous decisions. So the bad thing, though, is now we need some sort of rules to decide which of these projects or investments to accept or invest in and which to reject. And I'm not being overly dramatic when I say run away from screaming because there are definitely some bad projects and investments out there. So we're going to have to find some rules here to help us know the good from the bad. And so we have plenty of them, and some of these rules are going to be better than others. And in this lecture, we are going to discuss what these rules are, how to apply them, and what are the advantages and disadvantages of each. In order to know what is a good investment rule, we have to have some criteria to look at to judge each rule. And we have three things that we look at. The first is, does the rule account for the time value of money? In other words, if it treats a cash flow in year 10 the same way as it treats a cash flow in year 1, then it does not account for the time value of money. And we know that the time value of money is a real concept that people pay attention to. Secondly, we should have a rule that accounts for the riskiness of cash flows, because you could have two identical sets of cash flows, one for a safe project and one for a risky project. And definitely the set of safe cash flows would be worth more to us, so we need to account for that riskiness of the cash flows. And finally, we would like for our rule to provide information regarding the wealth created by the project. Why? As managers, it's our job to maximize shareholder wealth. So by adding to the wealth of the company, we have added to the wealth of the shareholders. So we need to have this last piece of information to help us to know whether or not we are achieving our goal of maximizing shareholder wealth. The first rule we're going to look at is the net present value rule. Net present value is simply the difference between the present values of the project's future cash flows and its initial cash flow. Now that definition assumes that all of the investment happens up front. Actually, we can have investments in pretty much every period. So perhaps what we should say is, this is the sum of the present value of all investment cash flows, with negative cash flows being cash outflows and positive cash flows being cash inflows. The rule is that we accept all projects with net present value greater than 0, and we reject all projects with NPV equal to or less than 0. Now, why do we do that? Because accepting positive NPV projects increases shareholder wealth. In fact, shareholder wealth increases by exactly the same amount as the NPV of a new project. So if I accept $1 million positive NPV project and there are 1 million shares outstanding, in theory each share should go up by $1 in value when I announce the new $1 million positive NPV project. Now that's consistent with our goal of financial management, which is to maximize the wealth of our current shareholders. Now before we leave this slide, I want to give you something to think about though. When we do these projects, when we do these forecasts and estimates, everything in there is merely a forecast or an estimate. It is not known with certainty. And so though in theory and on quizzes and exams we would accept any project with an NPV greater than 0, in reality we would want to use some judgment. Example, a project has a positive NPV of $12. In theory we accept that every time. But let me ask you this, what if you had to invest $1 billion in order to be able to collect that $12 NPV? Knowing what you know about forecasts and estimates, are you certain enough that it's going to be a positive NPV project for you to go ahead and invest the $1 billion? So, once again, on quizzes and exams, accept all positive NPVs. However, in real life, use some judgment. For each one of these rules, there is a set of ingredients needed to calculate the decision criteria. And for NPV, we need to know the initial investment amount, the future cash flows and their timing, and a discount rate that's appropriate to the risk of the future cash flows. Every single one of these items has some difficulties associated with finding it. Let's start with initial investment amount. It's the easiest of them all. If we are buying a machine, we simply get a quoted price from the machine from the vendor. And then we get a quote from a millwright to install the machine, and you should be able to come fairly close to the amount, although there will still be some unexpected things. For instance, if you are building a factory, you might find that the place where you're trying to build a factory has a sinkhole, and that might take some money to fix. Or you might find that there was some sort of historically important burial ground there, and you would need to buy new land to relocate the graves and pay to have that work done. And so there are always unexpected events that cost you extra money in a project. I have hardly ever seen unexpected events that save you money when you are starting a project. Now, more difficult to find out are the future cash flows and their timing. First of all, we have to be able to estimate what those future cash flows are going to be. And it's not always easy. For instance, your future cash flows may depend on fluctuations in the market. You're building a plant to build luxury automobiles, and just as the plant gets finished, a recession hits. Do you think that would impact the future cash flows of a luxury automobile plant? I think so. Also, the timing. Think about Boeing 787. That thing took off 3 years late. Do you think they had a 3-year delay incorporated into their net present value analysis when they were making the decision to build the 787? Absolutely not. And finally, a discount rate appropriate to the risk of the future cash flows. We've already discussed how to find this and how to modify it for riskier or less risky projects, but it's still not a simple matter to do. Let's work a simple NPV example. We have $100. We can either invest this cash and pay a dividend today of 107 1 year from today, or pay out a dividend of $100 immediately. Our investors can earn a 6% return on their money. What's the NPV of investing the cash versus paying the immediate dividend? Well, let's look at what the cash flows are. We have a cash flow of minus 100 for this project at the beginning. Why? Because our investors have foregone $100 now in order to make this investment. In exchange for that, though, we tell them we will give them 107 a year from today. So what are our shareholders actually interested in? They're actually interested in which project makes them more wealthy, the immediate dividend or waiting a year for a dividend. And the difference between those two is going to be the net present value of making the investment. How do we do that? Well, we need to find the present value of that $107 a year from today. So 107 divided by 1 plus R, which is 1 plus 0.06, gives us $100.94. When we add that to the negative 100 we used for our investment amount, we figure out that we have a net present value of 94 cents. So, do we accept or reject this project? Well, the rule says if it's positive, we accept. So we do. Now, what does that mean for shareholder wealth? It means that deciding to make this investment and pay the dividend a year from today has raised their wealth by 94 cents versus paying the dividend immediately. So now we need to examine our NPV criteria against the investment rule criteria we discussed earlier. And the first one is, does NPV account for the time value of money? The answer is yes, because we are finding the present value of the future cash flows. That brings it all back to time 0 and therefore we are accounting for the time value of money. The second question is, does NPV account for the riskiness of cash flows? And the answer is yes, though this may not be immediately apparent. How does NPV account for this riskiness? Through the discount rate. Remember, we found a discount rate that is appropriate to the risk of the project. And finally, does NPV provide information regarding the wealth created by the project? Absolutely. In fact, NPV is the amount of wealth created by the project. So we actually have a number in dollars and cents of the amount of wealth created by the project. The fact that we can answer yes to all three of the criteria tells us that NPV is the gold standard. Therefore, NPV is the rule that all other rules must be compared against. NPV works every time. There will not be any situation in which NPV will give you the wrong decision given appropriate inputs. Let's talk about the payback period. That's our next investment criteria. What is the payback period? That's the amount of time that it takes for a project to break even. And we calculate it by adding back the future cash flows, which we hope are positive, to the original negative cash flow until we hit zero. And at that time you hit zero, that's your payback period from the beginning of the project till you hit zero. And what's the rule? The rule is to accept all projects that pay back on or before an arbitrary cutoff. What do we mean by arbitrary cutoff? Well, that's a number of years usually that a manager just pulls from thin air, and that becomes your line that you judge by whether a project is acceptable or unacceptable. So what are the ingredients that we need for payback? Well, first of all, we need to know the initial investment amount. Second, we need to know the future cash flows and their timing. If this is sounding oddly familiar, it's because the first two we also need for NPV. But things changed with the third one. Now we need an arbitrary cutoff, expressed in years, to judge by. Once again, that's just a number that a manager pulls from the air. So here we have an example to show how to do payback. We've got cash flows for time zero, that's when you make the initial investment, and for 3 years thereafter. We're told that our arbitrary cutoff is 2 years. That means we're going to accept this project if it has a payback of 2 years or less. Now, the way that I like to work these problems is to create a third column, and I call it balance, and I consider it to be like a loan balance. Assume that you borrowed the $50,000 at time zero on a no-interest loan, and that as you get these positive cash flows in the future, you take all that money and pay down the loan. And so our balance at time zero is minus $50,000. After we receive $30,000 at time 1, now our balance is negative $20,000, because negative $50,000 plus $30,000 is negative $20,000. In year 2, we receive $20,000, and we add that to our negative $20,000 balance to get 0, because negative $20,000 plus $20,000 is 0. Do we need to go any farther? No, because the balance is 0. And that means we have achieved payback. What's the payback period for this project? It's 2 years. It took us 2 years to get to a 0 balance. Our arbitrary cutoff was 2 years. Do we accept the project? Yes, because the rule is if it is equal to or less than the cutoff, then you accept the project. Well, that last example was just a little too clean because the payback hit exactly on a year. Do you think it always happens that way? No, in fact, most of the time it doesn't. So we need to be able to handle it when the payback happens between years. So let's do the example again, only now let's assume that we negotiated the price of the machine that we're buying down to $40,000. And so our initial investment is minus $40,000. And we have that as our balance for year 0. Year 1, we receive 30,000 positive, which brings our balance up to minus 10,000. And in year 2, we receive 20,000, and that brings us up to a balance of positive 10,000. Well, wait a minute. What happened to our 0 balance? Where is it at? It happened somewhere between year 1 and year 2. So how do you handle this? Well, it's not enough in finance to say, well, it's between year 1 and year 2. We have to give a decimal. How do we give a decimal? We'll start with the number of the year with the last negative balance. That's year 1. And so we're going to take 1 and then we're going to add something to it to get our decimal. What are we going to add? Well, basically we're going to take the remaining money that we owe, in this case $10,000, and divide by the amount of money we expect to receive in the next year, in this case $20,000. So 10,000 divided by 20,000 is 0.5, and so we would say the payback period for this investment is 1.5 years. Now, that implicitly makes the assumption that cash flows are even throughout the year. And judging from the declining nature of these cash flows, I would think that's probably not correct. You'll probably receive more money in the first half of the year than in the second half of the year. But we don't have any information on that, so we have to make the assumption that the cash flows throughout that year are even. So it's time to bounce payback off of our 3 criteria for investment rules and see how it fares. First of all, does payback account for the time value of money? Absolutely not. It treats money in year 1, 2, and 3 identically the same, and we know that $1 now is worth more than $1 a year from now, so that's not right. Now, does it account for the riskiness of the cash flows? Once again, the answer is no. Those cash flows that we just looked at could have been for equipment for a dairy or for a nuclear weapons disposal site. One of those would be considerably more risky than the other. Payback doesn't account for that. And does payback provide information regarding the wealth created by the project? Once again, the answer is no. So payback is a real loser of an investment criteria. It's got 3 strikes against it. We've already talked about how payback method does not consider the time value of money, but there's another problem with it. It doesn't consider the cash flows after payback. We can see both of these problems illustrated in this table. Projects A and B both have a payback of 3 years, but which one of them would you prefer? Well, you'd prefer B because you get more money sooner. So the time value of money would lead you to choose B. However, payback period tells you that these projects are equally desirable. Furthermore, look at B and C. Down to year 3, which is when they pay back, these projects are identical. Payback period would tell you that these are equally attractive. But it's not the case. Why? Because C in year 4 has a $60,000 cash flow. Payback period doesn't take that into account. Something like net present value, however, would. Now, in defense of people who use payback period, I have never in the real world saw a payback scheme like C. It would be very odd for that to happen. The payback from projects typically looks more like A or B. So if payback period is such a piece of junk, why do people still use it? Well, for one thing, it's simple. Even people without a TIBA 2+ can make it work. And a lot of times the suggestions for improvement and for small projects, those come from people on the shop floor that might not have the advanced financial knowledge that the MBA student does. And so it's good for those kinds of folks. Smaller projects like replacing the company pickup truck, probably the NPV of those projects would be smaller than the cost to produce the NPV analysis. And so payback might be sufficient. And besides, payback often leads to the same conclusion as NPV. It's also good for firms with scarce capital and lots of growth opportunities. What do we mean by that? Well, typical finance theory assumes that if you've got a good project, that there will always be someone willing to invest in your company. That's not always the case, and so we end up with scarcity of capital, but sometimes we have lots of growth opportunities. For instance, when I went to work for Halliburton, the company had been poorly managed for several years, and as a result was in bad financial shape. The capital markets weren't smiling upon it with lots of cash at low rates, and we had lots of things that needed to be fixed, lots of little projects that would save lots of money. And if you've got that kind of a situation, what you want to do is invest your money and get it back as quickly as possible so you can invest in another opportunity. And so that's exactly what we did. We only took projects that had paybacks of 2 years or less, and as we got the money back from those projects, then we proceeded to reinvest in fixing other problems. And finally, the payback method provides quicker feedback on managerial decision making. If you do NPV alone, then it's possible for managers to do what we call a hockey stick cash flow projection. And so they might say that in years 1, 2, and 3, the cash flows, positive cash flows from the project will be relatively small, but then they grow precipitously in 4, 5, 6, and 7 down the road. And what this does is, even though those cash flows are further out in time, they can be big enough to make the NPV of the project positive. Typically what happens after that is the manager will find another job within those 3 years before those extra high cash flow projections are available for scrutiny. And so basically this allows managers to get projects accepted without having to bear responsibility for what happens down the road. The payback method, on the other hand, doesn't allow that, because you have to pay off in a certain amount of time, and if the project doesn't pay off, you don't accept it. And so that's what we mean by providing quicker feedback on managerial decision making. Okay, earlier we said that payback suffers from the difficulty of not adjusting for time value of money. And we have another rule, another criteria called discounted payback that does. And in discounted payback, all that you do is discount the current cash flows to present day. Now that solves the lack of time value of money, but it's still a piece of junk. In fact, it requires the same ingredients as NPV plus an arbitrary cutoff. Now this kind of reminds me of when I was a kid. My mom would take a ground beef, crackers, eggs, and ketchup, all things that I enjoyed in, hamburgers and fried eggs and things like that, but then she would mix them all together and make something totally awful. It's called meatloaf. And I always wondered why you would take lovely ingredients and make something so awful as meatloaf. And that's what we do here. We are taking the ingredients that we could use to make something lovely, NPV, and using it to do something not so lovely, discounted payback. The only problem of payback that discounted payback solves is the lack of time value of money. It doesn't solve the cash flows that happen after the payback. It doesn't solve any of the other problems. It only solves that one. So, if we've got the ingredients to make NPV, let's do that instead. Okay, let's talk about average accounting return. Average accounting return is simply the average project earnings after taxes and depreciation divided by the average book value of investment life over the life of the project. Now, that's a lot of words. I think we could say it more simply. How about average net income over average book value? So what ingredients do we need for average accounting return? Well, first of all, we need the projected accounting earnings of the project. In other words, net income. We need to know the investment amount and the depreciation schedule. Why do we care about a depreciation schedule? Remember that the bottom of this thing is going to be average book value. And the way that we calculate book value in any given year is initial investment minus accumulated depreciation. In other words, all the depreciation that's been charged off against the asset to that point. And so we need to know what the depreciation schedule is so we can calculate depreciation, so we can calculate the book value. And finally, we need a minimum acceptable AAR. Well, once again, this is an arbitrary cutoff that some manager, in this case an accountant, has come up with out of thin air. And so what's the rule? The rule is we accept all projects with an AAR that is greater than or equal to this minimum AAR or arbitrary cutoff. Let's work through an AAR example. Here we have some financials for a project. We have 5 years worth of cash flows. Now notice that we have net income for 5 years, and so it's easy to figure the average net income by adding those 5 together and dividing by 5. Our average net income here is $50,000. It's a little more tricky to figure out what the average investment is. We know that the initial cost of this project is $500,000. How do I know that? Well, that's the first book value that shows up here. When you first put a project on the books and there hasn't been any depreciation, it goes on the books at its initial cost. Every year, though, we have depreciation of $100,000. You can see that in the middle of the table above. And so that means at the end of year 1, this thing is only worth $400,000 on the books. At the end of year 2, it's worth $300,000. At the end of year 3, it's worth $200,000. At the end of year 4, it's worth $100,000. And at the end of year 5, it's worth nothing. So we have 6 book values here, because we have years 0 through 5, not just years 1 through 5. So we're going to add all those together and divide by 6. And the answer is $250,000. Now you may notice that $250,000 is exactly 1/2 of the initial investment. And as long as we do straight line depreciation to 0, which is exactly what we're doing here, then your average investment will always be 1/2 of the initial investment. Once again, that only works though if you're doing straight line depreciation to 0. Is the average investment worth exactly 1/2 of the initial investment? Now some of you will work this in the homework, and then you will look at the solution and you will say, why did they divide by 2? This is the answer to your question, because if you have straight line depreciation to 0, the average investment is 1/2 the initial investment. And so now it's a simple matter of taking 50,000 divided by 250,000 to see that the AAR is equal to 20%. Now, is that good? Who knows? Because this is an arbitrary cutoff that we're judging against here, this number is not comparable to a rate of return we would determine for the financial markets. These are accounting numbers. And so all we can do is judge against the arbitrary cutoff that we've been given. For instance, in this case, if the arbitrary cutoff was 18%, we would accept the project because this is higher. If the arbitrary cutoff was 25%, we would reject this project because it is lower. Let's take a look at the AAR versus our investment rule criteria. Does AAR account for the time value of money? Absolutely not. It treats $1 worth of net income from year 5 the same way it treats $1 worth of net income from year 1. So the answer is no. Does it account for the riskiness of the cash flows? No. Let's think about this. This number that the manager or accountant pulls from the air doesn't have any basis in the financial markets where the price for a certain amount of risk is determined. And this doesn't do that at all. Now you might require a higher AAR for riskier cash flows, but that doesn't mean that AAR accounts for the riskiness of the cash flows. And finally, does AAR provide information regarding the wealth created by the project? Once again, no, it doesn't. There's no number at the end. There's not even an indication as to whether or not we are creating or destroying wealth. So if AAR is such a piece of junk, Why do people still use it? Well, first of all, the numbers to do AAR are readily available and people in general are lazy. Why are the numbers readily available? Because they're accounting numbers. Every company has accounting books, and most companies have ready access to an accountant. If you want to make an accountant's day, walk into their office and ask them for some numbers. It's what they live for. Secondly, it's easy to calculate. There's no time value of money involved here. There's no calculus. It's very easy. And a third reason is that stockholders and media pay more attention to accounting returns, ROE and ROA, than finance folks think they should. And AAR is related to those through its emphasis on net income and assets. Remember that ROA is net income over total assets, and what we're talking about here for AAR is net income for a project versus the assets for that project. And then my favorite reason why people still use AAR, because sometimes your boss is an accountant. If you end up getting an accountant for a boss, don't be surprised if they ask you to use AAR when you are evaluating investments. Our next measure is the internal rate of return, or IRR. IRR is simply the discount rate that makes the net present value of a project 0. So all we do is set NPV equal to 0 and solve for R, which is actually much more difficult than it sounds. What's the rule? The rule is to accept all projects with IRR greater than the appropriate discount rate. This is the same discount rate we would use in calculating NPV. So what are the ingredients we need to calculate IRR? Well, we need the initial investment amount. We need to know the future cash flows and their timing. And we need to know a discount rate appropriate to the risk of the future cash flows. Does that look familiar? It should. All three of these things are exactly the same thing we use to calculate NPV. Let's work a simple IRR example. You have a project that will pay $110 1 year from today for an investment of $100 today. What's the IRR? Well, we start out by setting up NPV. And NPV is equal to the negative initial investment plus the present value of the future cash flows. In this case, we only have one, the $110 a year from today. How do we get present value of a cash flow 1 year into the future? We just divide it by 1 plus R. It's actually 1 plus R to the t, but in this case, the t is 1, and therefore it's invisible. Remember now, to get IRR, we set the NPV equal to 0 and then solve for R, which will be our IRR. In this case, we can just do a little algebra to find out that the return here, or IRR, is 10%. Well, that looks really simple, but it's not really that simple. The last example was easy because we could actually solve for R. But what happens when you have cash flows over multiple years? You end up having to guess, a process called iteration, which is extraordinarily painful and time-consuming, or you can use your TI-BA2+. Let's do an example that's a little more complex. An investment of $200 today earns you $100 per year for the next 3 years. What is the IRR? Well, the answer can be found easily using the CF key on your TI-BA2+. The CF key is immediately to the right of the second button. And so what I want you to do right now is take your calculator and hit the CF button. Now, to make sure that your calculator is clear from any previous cash flows, when you use these keys, you always want to hit second and then the clear button in the lower left-hand corner of your keypad. Now, this is different than when we did time value of money. Then we did second clear TVN, which I believe is over the future value key. But this time we're doing second and then CE/C, which is in the lower left-hand corner of your keypad. So now that we have that cleared out, we should be able to enter our first cash flow. If you don't see CF0 on your screen right now, go ahead and hit the CF button again. And we want to type in 200 and then the plus minus key. Now you're going to have to hit enter to get the calculator to recognize this, because if you don't, it's like it never even happened. Now we're going to arrow down after having hit the enter key, and we'll type in C01. That's the cash flow at time 1. And we're going to type in 100 and hit enter, because if you don't hit enter, it's like it never even happened. And then you need to arrow down one more. Now you'll see F01. Here we want to put in 3. Why? Well, that F01 tells you how many times in a row the cash flow immediately above it takes place. So F01 of 3 tells us that there are 3 identical cash flows of the amount of C01. Where did we get the 3? It's the $100 per year for the next 3 years. After you've got 3 in there, hit enter, or it's like it never even happened. Now we need to figure out the IRR. Your calculator has an IRR button. Please find it now. You want to go ahead and hit the IRR button and then hit CPT for compute. And when you do, you'll find that the internal rate of return for this project is 23.375%. Now, if you wanted to prove to yourself that this would give you an NPV of 0 given these cash flows, what you could do right now is hit NPV, and the first thing that will appear is I, and you could type in 23.375 and hit enter, then arrow down and hit compute. You should get 0 or something very close to it. Now, one other thing I want to point out to you is when you calculated IRR, did you notice that it took a really long time for that number to pop up? That's because your calculator has to guess to find the answer or iterate the same way you would. No kidding. So now we know what IRR is and how to calculate it. We need to figure out how it does versus our investment rule criteria. Does IRR account for the time value of money? Yes, it does, because as future cash flows, we are basically finding the present value of them. Remember, this is basically an NPV analysis that we're doing. We just don't know the rate of return. So yes, it does. Secondly, does it account for the riskiness of the cash flows? It really does, because we are going to use that discount rate that is appropriate to the risk of the cash flows as our cutoff. So it does. And finally, does it provide information regarding the wealth created by the project? And here the answer is yes and no. We know that if IRR is greater than the discount rate, then NPV is going to be positive. So if IRR is greater than the discount rate, we have created wealth. What we don't know is how much. Remember, that's something that NPV gives us that IRR doesn't. So I'm going to give IRR 2.5 stars out of 3. In addition to not telling you how much wealth is created, there are other problems with IRR. The first one I want to tell you about is the independent versus mutually exclusive projects problem. An independent project is one where the acceptance or rejection of that project can take place without considering any other project. Whereas a mutually exclusive set of projects, you can either do one project or another, but you can't do both. Okay, here we have a mutually exclusive projects example. There's a street corner that you own in Los Angeles, and you have two choices as to what you can build there. You can either build a snow cone stand, which we'll call Project A here, or a really ritzy nightclub, which we'll call Project B. Now, if we just use IRR, let's start out doing IRR, and we will figure out which project would be preferable using IRR. So get your calculator out, and the first thing I want you to do is hit your CF key, then I want you to hit second, and then I want you to hit CE/C down in the lower left hand corner. That gets rid of all your old cash flows. Then I want you to type in 100 plus minus and enter. That gets that first cash flow in there, CF0, it's your time zero cash flow. Then we're going to arrow down. For C01, I'm going to put in 50 and hit enter, and then I'm going to arrow down. And for F01, I'm going to put in 3 and hit enter. Why? Because that payment occurs 3 times in a row. Now, to calculate the IRR, I'm going to hit the IRR button. And it's going to say 0 to begin with, but I'll hit the compute, and it comes back 23.375 and some change. Now you may notice that that is identically what we got for our last example. And the reason is the first cash flow is twice the size of the next 3, and there are 3 identical cash flows and then nothing more. It's the proportions of these cash flows that matter for calculating IRR. We could have gotten the same answer if we had done minus 1,000, 500, 500, 500. We would get exactly the same IRR. Okay, so that means that the IRR for Project A is 23.375. Now, while we still have those cash flows in our calculator, let's go ahead and calculate the NPV for that project. Let's say it's a 10% required rate of return. So I'm going to put 10, I'm going to arrow down, 10, enter, you've got to hit enter. And then I'm going to compute NPV. I'm getting 24.34. 24.34. So we'll remember that number. Okay, now we're going to go look at the other ones. The Project B, the nightclub. And I want you to hit CF, second, clear work. That clears its little mind. And we're going to put in 1,000 plus minus, enter, arrow down. Now we should have C01 on the screen. And you want to type 450, enter, arrow down, and F01 is once again 3, enter, because that payment happens 3 times in a row. Now I'm going to hit the IRR button and compute. Now the IRR for this project is only 16.65. The IRR for Project A was 23.375. Which one looks better at this point? Well, if a higher IRR is better, then Project A would be a good bet. But let's just for giggles look at what the NPV would be for this project, because after all, NPV is the gold standard. So I hit NPV, and I hit 10, enter, arrow down, and compute. I'm getting 119. That's much larger than the NPV for the first project. How can that be? Well, we did earn a higher rate of return on the first project, but the problem is one of scale. We could only invest $100 at that nice IRR of 23.375, whereas we can invest $1,000 at the lower IRR of 16 point something. I forget what it was now. But that gives us a much higher NPV. So which do you go with, NPV or IRR? Well, we can always go back to the goal of financial management to answer that question. And the goal of financial management is to maximize current shareholder wealth. How do we do that? with the higher NPV project, not with the higher IRR project, because NPV represents the amount of wealth the project creates. So this is the problem with mutually exclusive projects. IRR does not take the scale of the project into consideration. Let's look at another problem using IRR, and that is that sometimes there's more than one IRR. For instance, we're going to look at Project C. Project C requires an initial investment of 100, provides a positive cash flow of 230 in period 1, and then requires an additional investment of minus 132 in period 2. Now, what kind of project looks like this? Well, in the mining industry, if you are doing surface mining, like strip mining, you have to replace everything after you're done just the way it was before you started. And so there's a tremendous expense on the back end, hauling in new dirt, rocks, and boulders and whatnot, and planting trees to replace the environment exactly as you found it. And people know this when they start a strip mine, and so they have to include it in their planning. Now the problem is that anytime you have a sign change, you cross the x-axis for the NPV profile, which I'll show you what that looks like here in a second. So anytime I have a sign change, basically I end up with another IRR. Now if you put these cash flows in your calculator and ask it to calculate IRR, it will only tell you the first IRR, which is 10%. But there's another IRR at 20%. So what does this mean? How can we solve this problem? What we see here is an NPV profile for Project C. Basically on the vertical axis we have NPV, and on the horizontal axis is the discount rate. And so what this really shows us is that for this project, we should accept the project for any discount rate between 10 and 20. But we should reject the project if the discount rate is higher than 20 or lower than 10. Why? Because in those regions, NPV is negative. Now what would your calculator tell you to do? Your calculator would say if your discount rate is, or your calculator would tell you the IRR is 10%. And our general rule is accept the project if the IRR is higher than the discount rate. What would that do in this case? That would cause us to accept a negative NPV project. And we know that NPV is always right. So in this case, IRR must be steering us wrong. So with all these problems, why do people still use IRR? Well, for one thing, it sums up a project in a single number for which people have a feel, an interest rate. If I tell you that I have a car loan at around 6%, you're not going to be overly surprised. But if I told you I had a car loan at 32%, you would instantly be shocked and horrified. And so we have a feel for what rates of return should be. And so this is good for explaining to managers who might not have the same sophisticated financial background that you do. If the IRR is high enough, you might not even have to find the appropriate discount rate. An example, the IRR of replacing the company pickup truck is 45%. Do I really need to know whether the appropriate discount rate for that project is 7% or 11%? What kind of thing could we be doing with a pickup truck that would require greater than 45% return? I can't think of anything legal that would fall within that category. Okay, now we're to our final investment rule. It's called Profitability Index, and it's just the present value of cash flows subsequent to the initial investment divided by initial investment. And if you recall, NPV is equal to the present value of cash flows subsequent to the initial investment minus the initial investment. So we can just rearrange that equation and also say that profitability index is equal to initial investment plus NPV divided by initial investment. And then we can do some algebra magic and cancel out initial investment and come up with a 1 plus NPV over initial investment. Now, looking at that last one and knowing that we accept all positive NPV projects, you can probably guess what our rule is going to be. We're going to accept all projects with a profitability index greater than 1. After all, any positive NPV will give us a profitability index greater than 1. What if NPV is negative? Then we will end up with a profitability index that is less than 1. So what ingredients are needed for profitability index? Well, we need the initial investment amount, we need the future cash flows and their timing, and we need a discount rate appropriate to the risk of the future cash flows. Look familiar? Should. They're the same ingredients we needed for NPV. So let's bounce profitability index off of our investment rule criteria. Does PI account for the time value of money? Yes. Remember, it's got the present value of the subsequent cash flows in it. Does it account for the riskiness of the cash flows? Yes, through the discount rate that we chose that's appropriate to the risk of those cash flows. And does it provide information regarding the wealth created by the project? In this way, it's like IRR. It tells us that wealth is being created so long as PI is greater than 1, but it doesn't tell us how much. So just like IRR, I'm going to give profitability index 2.5 out of 3 stars. So when is this profitability index really useful? Well, during something called capital rationing. That's when we don't have an endless amount of capital available. Remember that most finance theory supposes that we have an endless amount of capital available as long as we have a good project, but that's not always true. For example, during 2008, financial markets froze up and you couldn't get capital even if you had the best project on the planet. And so, during those times, firms tend to run on internally generated capital or additional retained earnings. So, how do we decide which projects to undertake in those situations? Well, we can rank projects by descending profitability index and then invest going down that list until we run out of money. In other words, till we run out of the amount of capital that we do have to invest. Doing this gives you the biggest bang for the buck. Now, some examples from the real world. If you're a startup firm, you probably don't have access to endless amounts of capital. And the Federal Emergency Management Agency, they have funds set aside every year to purchase properties in low-lying areas and destroy the buildings there and basically keep those properties from flooding. Why would they do that? Because when those properties flood, FEMA's responsible for paying for the damage and fixing it. And so they can avoid future cash outflows by purchasing those properties and destroying the structures now. It's important to go ahead and destroy the structures because otherwise squatters will move in and you'll have a potential crack house in a flood zone. So every year when FEMA puts out their requests for submissions for properties to purchase, one of the things that they ask the applicants to do is to calculate this profitability index. And they receive all the applications and make sure they meet the specifications, and then they sort them in descending order of PI. And they assign funds to the projects going down the list until they run out of money. Profitability index suffers from a same problem as IRR, and that is it can lead to bad decisions for mutually exclusive projects. Remember our snow cone stand or nightclub in Los Angeles? The problems of scale show up again because what we're doing here is taking the net present value and dividing by the initial investment. So once again, we're back to a ratio type of measure instead of an absolute dollar measure. Now we know the project B has a higher NPV than project A, but if we calculate profitability index, project A will actually have a higher PI than B because the NPV is bigger as a proportion of the initial investment. I'll let you work through these on your own and determine if what I've said is true. So we've talked a lot about finance theory and about what's good and not good about these different measures. You may be curious as to what happens in the real world. Well, some folks did a survey of real people who do this kind of work, and they asked them how often they used these different measures. This is a table from the book, by the way. And so firms indicated a frequency on a scale of 0, meaning never, to 4, always. Okay, so it looks like for large firms and small firms, we see that they use IRR and NPV about the same. Now, why would that be? Well, NPV is the gold standard, but once again, IRR is a measure that people can intuitively understand. So this makes perfect sense. Now, the payback method is slightly less popular, although it's more popular with small firms than with large firms. Why would that be? Well, first of all, small firms may not have a lot of finance folks just hanging around. And secondly, they probably tend to have small projects, and payback method usually works just fine for small projects. We see that discounted payback is a dog with fleas, and not many people use it. Even worse is the accounting rate of return. And you can guess that there's an accountant involved whenever that thing is required. And finally, we have the profitability index. Now, the profitability index is a fine measure, but it has a very specific use, and that is for periods of capital rationing. And as we've discussed, for most firms, that is seldom the case.